Hi Fools, welcome to Market Checkup, the Motley Fool's healthcare-focused investing show. I'm David Williamson, and I'm joined as usual by Michael Douglas. Michael, thanks for being here today.
Good to be here.
We have a pretty jam-packed show as usual. I feel like I keep saying that, but it's earnings season, so things are busy. We've had a lot of movers. We have a couple today, both heading the wrong direction, unfortunately. A nice comparison between two competing biotechs. We have earnings from CVS.
Our last PBM.
Yep, well. and new FDA regulations for e-cigarettes too. So I know e-cigarettes are a popular discussion point, so we'll be covering that as well. Let's start with the movers as we always do, because that's where the action is. And unfortunately for Corcept, the action is going the wrong way. Corcept shares are down 50%. They've been cut in half after their quarterly results, but it wasn't the financial results that really caused it. It was clinical results that tripped up Corcept. An interim analysis for a phase 3 trial was for depression was stopped early when it looked like Corcept's drug wasn't going to hit statistical significance. And they don't really stop trials early unless it's a blowout one direction or another.
Yeah, and basically, they had the first 226 patients, and the independent safety committee basically said, well, it hasn't really helped these first 226, so let's not go ahead and get this up to 450. Let's just go ahead and cut it now. And Corcept said they're going to go ahead and sort of triage this off and focus in on a potential cancer indication for this drug,
Which is Korlym?
Yes.
And the one thing that strikes me about Korlym is how many indications it's going for.
Yeah.
It reminds me a little about Questcore's Acthar, which I guess is Mallinckrodt's Acthar now. But if we can put up the slide that shows all the different indications that Corcept's going for.
Yeah, it includes triple negative breast cancer, alcohol dependence,
it's really
psychotic.
It's just about everything between A to S. We have obesity on there, stress disorders, just about anything you could potentially want to treat. Korlym potentially treats it. That's kind of a red flag to me. I appreciate them trying stuff, but it looks like they are just seeing what sticks.
It feels a little scattershotty. Yeah,
absolutely. And when you take a look at Corcept overall, they have $43 million in cash, $35 million in debt, and a burn rate of $37 million.
Yeah, when I look at those numbers, especially because I think they're expecting some results early 2015.
That's a long dead period.
Yeah, especially when you look at, where their cash is and their cash flow.
I'll tell you what's going to happen before 2015.
Dilutive share offering?
Yes, there will be a capital raise via a secondary offering. So, I think when you take a look at a stock like this, it's a development stage drug maker. It's incredibly risky. It's a stay away from me. There's no real catalyst in the short term either.
I definitely agree. All
right, well, let's move from one stock that's down to another stock that's down. But this is actually a battle of the biotechs.
Yeah.
Two popular ones, Isis and Agerion. They both reported quarterly results in the last couple days. So we figured a head-to-head comparison would be good.
Yeah.
Neither fared great. Isis fell 4% reporting, and then another 4% today. Agerion just reported. They're down 25%, so definitely worse for Agerion. I don't know which one you want to start with, but
let's start with Agerion, I guess.
Perfect.
Adjusted net loss at 25 cents a share, which was cut last year's adjusted net loss about in half. On a GAAP basis, that was a loss of 54 cents a share. Analyst expectations have been a narrower 35-cent per share loss. So a pretty big miss there.
Yeah, I think the real problem was Juxtapid, their HOFH drug. This is their drug, essentially. Didn't hit what analysts were looking for. It did $27 million in net sales, which is a dramatic increase from the $1 million the prior year when it was just launching. But the estimate was for 33.6, and when you're launching a drug, you don't usually want to miss those estimates. You want to see pretty fast adoption.
Right. Well, and also they decreased expectations on revenue for the rest of the year.
Yep, I saw that.
They reduced guidance down to 180 to 200 million from 190 to 210.
Which isn't too bad, but again, you're launching a drug, and this is an orphan, one of the most orphan indications. I mean, estimated 300 patients in the country, so you should see pretty fast adoption for that.
Right. Well, and especially I would say in this market, when you look at just how much biotech in particular has been getting kind of hit lately. If you're gonna miss on expectations for sort of your top line growth, if you're gonna miss on earnings and you're gonna lower your guidance, this is kind of what's going to happen. Should we talk Isis?
Yeah, let's talk Isis.
So also kind of a rough quarter there. Revenue of $28 million, down 35% year over year. A lot of that due to changes in timing of payments and license revenues. So not as bad maybe as that top line necessarily looks. Kynamro, which for the record, by the way, a lot cheaper than Juxtapid at only $176,000.
Yeah, versus $300,000.
Yeah, so a little bit cheaper there.
That's how you compete on price, Abby. That's how you compete on price.
Well, their total product sales or licensing revenues were I think 8.6 million. So definitely a little bit less there than on the Juxtapid side. But this is the drug that they're with Sanofi's enzyme unit. OpEx up significantly, up to 51 million from 39. Yeah, so that's kind of the top line. I guess the really big question that people are probably going to be asking is, okay, so you've got these two different drugs with pretty different price points that are both being marketed by these sort of separate companies. Which drug do we like better, and which company do we like better? So let's start with the drug.
And I think that's an interesting question, because you would look at these stocks initially and you think it's about the drug, but actually when you talk about what stock do I like better, it gets a little murkier because of everything that's going on with ISIS. But when you take a look at the drugs, when these were going through the FDA approval process, and the FDA approved it, and before pricing or any of that, I sided with the FDA advisory committee. I mean, Agirion's drug is better. That's why they priced it at a premium. It received I believe a 13-2 vote for approval. Kynamro received just a 9-6 vote. It really skated by. There was some questions whether Kynamro would get approved with such a narrow margin when Juxtapid was out there and didn't have some of the safety issues. Now, Sanofi said they cleared up some of the site reactions. But when you take a look at that, I would think Agirion's drug would sell better in this market. Now, they're estimated for roughly, I think, about the same in peak sales. But
400 million or so.
But, I think that's been validated, right? That Agirion is going to be the better seller here because it's selling better. As simple as that is. The question, though, long term is what stock do I like better? With Agirion trading at roughly, 2x peak sales, maybe it's not that expensive right now, but when you look at Agirion, that's kind of all you're getting, right? Is this drug. And there is more competition coming on the horizon as well. These PCSK9 drugs, Amgen's is the furthest along. Amgen just released trial results that showed, it working for HoFH patients. So that's a potential competitor, and that drug is going to be priced a lot cheaper than either of these. So this may not be a market that they can dominate by themselves. And again, it's 300 to 3,000 patients, and the 3,000 number may be a little optimistic. So I think when you take a look at the bigger picture, what stock do you like better? I think it's ISIS. It's got twice the valuation, but you look at their pipeline. I was printing it out. I can't even fit it on one page.
Right.
That's how big it is. And they have partners from just about everyone. I mean, Sanofi, Biogen's a big partner, Roche,
Glaxo.
Yeah, AstraZeneca. I mean, they're all here, and they're in a number of indications, from orphan disease to oncology to inflammation, cardiovascular, and it's all based on a platform, right? And the biotechs that tend to outperform over time aren't the one-trick ponies that if you miss by a little bit on your product sales, you get slashed 25%.
Right.
They're ones that have these broader platforms that they can license out drugs to different pharmas. They can get more consistent milestone payments, and they can rely on their in-house technology to keep continuing to develop new drugs. But what's your take on the two?
No, I definitely agree. And one of my concerns with Agirion actually has been sort of the issues they've been having with the FDA and the Department of Justice. So the FDA issued a warning letter in response to some comments their CEO had made, and then the Department of Justice went ahead and subpoenaed them for their marketing practices. Now, again, does this mean they're guilty of whatever this, whatever the DOJ suspects them of, perhaps? No, not necessarily, but it's definitely a concern. When you look at ISIS, I mean, that expansive portfolio of potential drugs is really, really big to me because it just gives you some diversification. And Although I will say, it's not all roses with ISIS's pipeline, right? They originally developed Costiricin with Oncogenics, which got licensed out to Teva and then just recently bombed a late stage trial in metastatic castration-resistant prostate cancer. So there is that, but between the two, I would definitely say I'm on ISIS's side here.
Yeah, I think it's a safer bet for investors.
Yeah.
Just because it's a platform that has had some success. I mean, Kynamro came out of it,
Right.
so it's not unproven. And it's not. If any one of these drugs fails, it's not going to dramatically impact ISIS's stock. The way
It can go along to 3 others.
the way if the PCSK9 drugs come in and compete and take some of that market share of what's a pretty small patient population, that could really spell trouble for Agerion in the future.
Very much so.
All right, well, let's move on to our next topic, which is more earnings, but we're going to a much larger company than these two.
Yeah.
CVS Caremark recently reported earnings. They were mixed. Market took it in stride, though. Shares were about flat, and I think that's largely because of the underlying strength in CVS's business. They maintained their full-year guidance despite the bad weather causing them to miss on earnings per share.
Yeah, well, and honestly, even that miss really didn't look too bad, right? And you had adjusted EPS of $1.02, which is 23% growth. I mean, that's good. Those are good numbers there, and about $33 billion in consolidated revenue.
Yep.
When you look at it by segment, should we break it out by segment?
Yeah, let's do it.
All right, let's start with we're at healthcare, so let's talk about the PBM first.
Yep. It continues to really just hit it's hit its stride, and it's firing on all cylinders. I mean, just really impressive.
Yeah, I mean, you had revenue up 6.3%, $20.2 billion. They're forming the new largest U.S. generic sourcing entity with Cardinal Health Venture. That's expected to go live as early as perhaps July 1st. Big increase in specialty medication spending. I think that's probably not surprising to people who've been kind of watching the sector, particularly this last quarter, up 16%. And their overall trend was 3.8%. And they just got a renewal on the Federal Employee Health Benefit Program.
Yeah, which is huge.
Yeah, for the next 3 years, starting 1st 2015.
There was some discussion when they decided to get rid of cigarettes in their stores that was so they could keep this contract, which was just so important to their business, that any hit they would take by not selling cigarettes would be dwarfed by what they would keep by keeping this contract, essentially.
Yeah, absolutely. So when I look at the PBM side, everything looks pretty good, to be honest.
I agree. You take a look at Minute Clinic. CVS is up to 32 health alliances now. They added a couple for the quarter. I think that's still incredibly important.
11% revenue growth in Minute Clinic.
Yeah, exactly.
Almost just over 800 clinics now, up 28. I mean, that's really, really good news there. And even on the retail side, honestly, even though there was kind of all of that hit from the bad weather, it wasn't terrible by any stretch, I don't think. A 3% growth in revenue, same store comps at 1.4%. Pharmacy comps up almost 4%.
Yeah,
these are still good numbers.
I think it was solid. I think when you take a look at CVS going forward, is you want to watch for the selling season when you back out that government contract which they've secured, and Aetna, about a third of its book is actually up the selling season, but early indications are CVS has a strong pitch, so they should do well, but that's something that I think investors do need to watch how that plays out.
Yeah, although fortunately I think Amerigroup is delaying by at least a year, so there's some good news there. But yeah, definitely something we'll want to watch moving forward.
Anything else catch your eye?
Hep C.
Sure.
Want to talk about it?
Yeah, why not?
So John Roberts, the PBM's president, basically said, and I quote, "We expect the impact to be minimal for this year." And just like we talked separately about with a couple of other companies, it looks like they actually did a pretty good job of kind of controlling for it, being ready for it.
Well, I think what's interesting is the mix you're seeing in industries. It's not one industry freaking out, another industry excited. It's really diverse, right? I mean, WellPoint didn't really have an issue, right, on the insurance side.
Not at all. They even lifted guidance.
Yeah, United Health did.
Yeah.
And you take a look at pharmacy benefits. Here, CVS, didn't mind. Catamaran didn't mind. Express Scripts is apparently on a path to war with Gilead.
Well, and that's what's so interesting, because you've got these market share leaders in both cases, right? United Health and Express Scripts are the number ones in both of their areas, and they didn't seem to control for it nearly as well as kind of the others. So, Just very interesting and kind of a different dynamic than I think we were expecting.
Yeah, I think so too. I think you just have to credit CVS for managing that a little better. I mean, I think that's kind of the bottom line.
Yeah.
CVS is a really interesting stock. I'm personally a fan of it. I think the Minute Clinic strategy is really smart, and I think sort of differentiating from their more, I mean, they're all going into the Minute Clinic, but I think getting rid of tobacco helped diversify, or not diversify, but shift their image as more of a healthcare provider versus some of their more retail-focused competitors like a Walgreens.
Yeah. Well, and when you look at their guidance, it's showing. You know, I mean, you've got 5.3 to 6.5% growth in revenue, adjusted EPS up 10 to 14%. Their operating expenses are growing much slower than their revenue. I mean, this is all really good news.
Yeah.
And even positive comps, even despite really what was a pretty terrible winter season.
Yeah, just awful.
So all in all, full steam ahead.
Yeah, it was a good quarter. So that's why you have to dig behind the numbers, because when you first look at the miss, you're like, oh no, CVS. But no, the strength was there once you dug behind the top line.
Very much so.
All right, well, let's move on to our final segment, which is the FDA and e-cigarettes.
Yeah.
Now, there's been a lot of dread out there because e-cigarettes weren't really regulated, and the government was basically saying, you know what, we actually probably should take a look at this.
Seems like a pretty good idea, right?
I mean, because cigarettes are. And so the FDA basically put out the regulation plan. And I'm going to say not too bad for the tobacco industry, actually, quite frankly. The regulations did include ingredient disclosures, no free samples. You can't call them light or mild,
Right.
Which is very specific. Minimum age rules, which seems kind of like a duh to me, like a no-brainer. And it did not include, though, and this is what I think the industry was concerned about, product standards, limiting flavors, because there's been a lot of concern about flavors like Tutti Frutti and other things.
Marketing to certain groups.
To the youth, yeah. And banning TV or other advertising, because obviously you can't advertise cigarettes on TV.
Right.
So I would say probably a net positive.
Yeah, I mean, when I looked at this stuff, I thought, okay, so you have to disclose your ingredients. I mean,
Nicotine.
well, there is that, but at the same time, I mean, welcome to any consumable product ever.
Yeah, exactly.
Right? No free samples. Okay, fair enough. Minimum age requirements, 33 states, I think, already had them in place.
Yep.
So really no surprise there.
Yep.
You need to be a certain age before you start using it. That makes sense to me. So really nothing, I thought, too red flaggy in there.
Yeah, I think if there's one part that's not all sunshine for the industry, though, it's going to be the approval process that
Going forward,
could trip them up. So what that is that after 2 years from now, any new e-cigarette has to go through an FDA approval process like a drug before it can be sold. So it's a pre-market approval process. In the meantime, the drugs that are on the market or are submitted or basically come to market in the next 2 years in that gap window have an additional 2 years from that date to sort of refile for approval. I mean, it's approval for the first time, but they have to be FDA reviewed at some point in the future. We don't really know what that secondary approval process will entail, and it could mean earlier, older e-cigarette models being phased out. Maybe the FDA wants to ban older models that they don't like as much, but that's purely speculation on my part. It will certainly increase product development costs, and costs are a bit of a problem in this. We'll get to that in a minute. But it could potentially make e-cigarettes less attractive as a business. And I think it'll break one of two ways. Either you'll see just a flood of new e-cigarette products in the next 2 years, so these companies can get that extra window, essentially, before they have to deal with the FDA. Or companies are going to say, all right, you know what, we're just going to hold off until we see what this approval process is all about.
Sure.
Because we don't want to spend the money developing something that's going to ultimately get pulled. But e-cigarettes, not really a great business.
Not at the moment. I mean, we're talking a total potential, at the moment, right, $1 billion market is kind of the number that keeps getting thrown around. Maybe that grows some more in 2014, but that's kind of the number we've seen for 2013. And $1 billion really isn't, I mean, it's a lot to you and me.
But not so much to these tobacco giants. You take a look at Lorillard, right? They dominate the market. They're by far the largest player. They don't even make money off 200 million in trailing 12-month sales. The last quarter they had sales of 51 million, gross profit of 16 million, and a net operating loss of 11 million. They lost money. And my concern is you take a look at some of the sales growth. It slowed to about 5% year over year, but 9%, right, sequentially.
Yeah, 9% decline sequentially.
9% decline sequentially. Yeah. And my other concern is there's 100% awareness in the polls for cigarette users over e-cigarettes, and yet they only make up 1.5% of smoking volume. So people are aware. People have tried this. There's been pretty good penetration of people who have tried it. I'm concerned people just don't really like it. And you take a look at the margins; they're nowhere near as good as cigarettes. Maybe they'll get better if everyone had the e-cigarette device, and then you'll make money off the the refills, essentially the cartridges. But I do wonder if this is where tobacco companies are going. If it's going to be a much less attractive business than it is now.
Yeah, I mean, I think you've got a point there. That said, though, I can't imagine that they're putting this money into this development without some expectation of ROI, right? So you look at Altria, for example, which is definitely not Lorillard when it came to e-cigs, right? They've been a lot slower in their rollout, a lot more, let's say, uncertain, kind of like United Health with the exchanges, right, compared to WellPoint.
Mm-hmm.
And Altria, has started rolling out its Mark 10 in select areas. In Arizona, 7 weeks. They picked up 48% market share in 7 weeks. So clearly, the blue brand isn't necessarily that strong always.
Yep.
But Altria also recently bought Green Smoke Inc. for 110 million. That's a company that sells e-cigs mostly over the internet. I think they see an opportunity here. I don't know if it's as big of an opportunity as most people seem to think.
Yeah.
I
don't think it's the disruptive technology that people expect it to be.
Right, it's not 3D printing.
Yes.
To editorialize a little bit. So I think it may be an arrow in their quiver, but I don't necessarily think it's going to be the biggest one.
Yeah.
I think probably overseas cigarette growth and things like that may be a bigger opportunity for these companies.
Yeah, I think that's probably a pretty accurate statement. But we'll be watching e-cigarettes to see how the market develops for them.
Yeah.
Thanks for watching. Stay tuned to Fool.com for all your healthcare news, and we'll be back next week with more market checkups. All right, thanks for watching. Fool on.